Hi, everyone. We'll get started. We have a lot of people. I'm looking here at the list, a lot of names I don't recognize. So that's exciting to have some new people here on the webinar. My name is Ben Driggs. I'm the president of Navigate Financial, and we appreciate your joining us today. Just to give you, while we wait for another 30 seconds or so before we begin, a couple of housekeeping items. We do these webinars once a month, the second Tuesday of every month. We try to think about topics that will be that are timely, that people are interested in. We've been talking about what we're going to be doing in November, and we'll be sure to let you know. We have an Instagram account. We invite you to follow us on navigatefinancial.com. That's been kind of dormant for the last month. But you're going to start seeing some things picking up on our Instagram. We are launching here in the next couple of weeks a weekly podcast. We have pre-recorded about 10 podcasts, and we're finishing this up, in the studio in terms of editing and whatnot. So those are going to be ready to go here in the next couple of weeks. We'll be announcing those and advertising them with video clips on our Instagram account. So you can expect to see that coming down the pike here in the next month. Again, these monthly webinars. On this call today with us, we have a lot of our current private clients. We have a lot of employees who work at companies that we help them with their 401k plan, and we welcome all of those. And then we have some people who are just from the general public. We certainly welcome your attendance. So let's go ahead and jump in. I have my able-bodied colleague, DJ, is going to be monitoring things too. So DJ, let me know if people aren't seeing things, etc. So let's go. Will people please give me a thumbs up if they can see the presentation? Okay. So, and as a reminder, we want to be really punctual on these. You can count on us to end at the bottom of the hour. So we have 27 minutes to talk about today's topic. And it, of course, is a timely topic. It is presidential elections and the stock market. So there are lots of different ways to look at this. This will not be a highly political conversation, but with people having a lot of interest in the election next month, I think it will be an interesting one. So let me. Here's what we're going to review. We're going to talk about the four-year election cycle. There is historically a pattern on the first, second, and third. This is the fourth year of the presidential cycle. We're going to be talking about how who controls the House and the Senate relative to the White House, how that historically plays into things, and how that is looking for the upcoming election. We're going to talk about how the economy is doing and how that tends to predict who's going to win the election, how the stock market is doing and how that tends to predict, and then how volatility, all those have some historical correlation with who gets elected. Then we'll talk about some areas of the market that might do well depending on who wins, whether that's Trump or Harris. And lastly, we'll finish with a general comment about market performance in election years. Please be sure to send any questions that you have into the Q&A box, and about halfway through and in the very end, we'll make sure that we answer your questions. So let's talk about the four-year election cycle. This first slide, you can see number one would be next year and thereafter. So we're in year number 4, and this is over the last 80 years or something like that. You can see that there is a winner on the year that tends to do the best. And interestingly, that happened again this last year. That third year tends to be a good year. What happens is the people who want to be reelected will do a lot to put into place. So in this case, it's the Biden administration is going to work really hard that third year to get elected the next year because they know there's a delayed effect. So the markets like that. And then the fourth year is also important because we want the stock market to be doing well when we are the incumbent so that people, when they go to the polls, they have a good feeling about things. So the third and the fourth year tends to be the best. You have some spillover into the first year where there's perhaps some enthusiasm with the new administration, a fresh start. And then reality sets in. And by far the worst year is the second year because reality sets in. We don't have the money to implement all those, exciting things we talked about. And that's a pretty predictable pattern. Again, do we want to bet our retirement on that? Perhaps not. But nonetheless, it's been a pattern that I've watched closely, and I'm not alone. A lot of people watch this pattern. So let's switch gears and talk about political parties and how that impacts that. So here on the left-hand column, you can see if you have everybody who's Republican, that's White House, Senate, and the House of Representatives. If everybody's Republican, average annual return over the last 100 years, a very attractive 14%. Very, very close is if everybody's Democrat. So if it's united, that tends to be good. Then you go, let's talk about divided. Divided with a Republican would be 7 and then 16 if you're divided with a Democrat. That third row is really where you see the difference. That's by far the worst performing times. And that would be, for instance, if Donald Trump wins, that would be Republican president. And let's say the Democrats take control of the House and the Republicans take control of the Senate or vice versa, and we have a divided Congress, that would not bode well for the stock market historically. Now, of course, we don't know. We don't have, 100 years seems like a long time, but it's really not that long. So it's tough to get serious data, but there are some patterns here. If history repeats itself, we would want Harris to win the presidency. And what may in fact happen is Harris wins the presidency, the Democrats take the House, and the Republicans take the Senate. And that could play out. So let's talk about where we stand on this, the House and the Senate. Currently, the Democrats in blue have a 51-49 advantage in the Senate, a very, very narrow lead, as everyone knows. That 47-4, the 4 is the purple, kind of not dyed in the wool. So now let's talk about the consensus. The consensus is we have 48 that will likely return as Democrats, 51 that are likely going to be Republican. Therefore, the current prediction is that the Republicans will take control of the Senate. Below that 48 are 2, which are purple, which lean Democrat. They're likely to remain Democrat, and that's why the prognosticators, they're thinking it's going to be 48-51. The one on the right is a toss-up. So we're probably at 48-52 or 49-51, something like that. But it's probably going to be the Republicans are going to probably take over the Senate. The House, you can see right now, it's very close. The consensus, 206, 208, 21 toss-ups. just really difficult to call. Most likely what will happen is if there's a pretty clear winner, uh, let's say that Harris ends up winning by more than expected, then that will likely follow down with the House, and the Democrats will take both the White House and the House of Representatives, and vice versa if Trump wins. Okay, let's switch gears here a bit. Let me pause. Let me see if there are any questions quickly. I have to change my screen here. Any questions? Oh, there are a few. Okay. What are the most common investor mistakes during election year? We'll answer that at the very end. The most common mistake is to bet on the elections. It's very difficult to determine these things. We don't know. It is akin to gambling. So if right now, if you're saying, I'm going to put all my money on Trump or Harris, it's a 50-50 shot. So it's not probably a very good gamble. And B, the stock market doesn't change that much based on who's president. As much as the presidency, the candidates would want to say they have a lot of control over the economy, the fact is they have very little control over the economy. So, when they're talking about, oh, Trump is better for the economy or Harris is going to do this or that for the economy, the fact is they have a very, very minimal impact over the economy. How could a contested election result? Again, I don't think that's going to be a big deal unless it spirals out of control, and then we're in really uncharted waters. I'm not sure. What markets are most affected? We're going to talk about that a little later. Is a market crash likely after the election? That would be quite unlikely. The market, I think, the stock market is equally comfortable with both candidates for different reasons. So regardless, on November 6th, I would not anticipate much of a significant move. How can I avoid risk during and immediately after the election? I think the answer would be probably do nothing. Let me just go on a tangent and mention that historically, the best 6 months of the stock market are October to April. It's the winter months, late fall, winter months that do best. If you look at May through the end of September, the stock market in the last 100 years is almost flat. So really, almost all the stock market gains are made during the winter and spring. For that reason, again, that's another common pattern. I would not want to be out of the market in November, December, January, February. So I do that. The last question, will this recording be mailed out? I think it's emailed out. I think Zoho, if you get reminders, and we will post it to our website. Okay, let's get back to the presentation. It is 14 after the hour. We have 16 minutes. Appreciate your questions. Keep them coming. And we are, in fact, about halfway through the presentation. So we're making good time. So what's the relationship between how the economy is doing and who gets elected? Not a surprise. The economy is very, very important. If we read this with me together, in the last 100 years, when the economy was growing in the 2 years leading up to the election, the incumbent president was reelected every time. By contrast, when the economy was in recession in the 2 years leading up to the election, the incumbent president was never reelected. You're almost talking about an absolute correlation with economic strength heading into the election and who gets reelected or who does not get reelected. Now, this year it's a little different. Biden is not the candidate, it's Harris. But we would think that Harris would be a close representation of the incumbent this year. So if we're to bet, We have had a good economy the last couple of years. There has been high inflation, which is offsetting the benefits of this high economy. So the Republicans are talking about inflationary woes. The Democrats are saying we are really, to be fair, the economy is strong, the economy has been growing, etc. So I think it's a little more complicated this year because you don't have a true incumbent and you have the inflation card. But I would say in general, the economy is doing well. And for that, and we're certainly not in recession. And for that reason, for this data point, you would bet on Harris. What is the relationship between the stock market and who gets elected? Now, the stock market is not the same as the economy. Over time, they're similar, of course, but they're different. So in the last 24 elections, when the stock market is represented by the S&P 500 index, when the stock market was positive in the 3 months leading up to the November election, the incumbent won 12 out of 14 times. As you likely know, the stock market has been positive this year. It's been positive the last few months. And for that reason, this bodes well for Harris. If the stock market were to be negative in the last 3 months, the incumbent lost the re-election 9 out of 10 times. So this data point would favor Harris over Trump. And lastly, what is the relationship between stock market volatility and who gets elected? This is a chart, so it's a little more complicated, but the volatility, the stock market volatility in the 1 and 3 months. So I want to draw your attention to the green line, the middle, that was 21.3 and 25.0. You'll see that that's kind of the peak. What that is saying is that there's a lot of stock market volatility, which is frankly a kind of not a pseudonym, a euphemism for the stock market's going down the month or the 3 months before the election, similar to this last slide. So if we're seeing a lot of market going down, up and down, drama in the stock market immediately, September, October does not bode well for the incumbent. Again, we don't have that. The stock market has been doing well. It's been pretty boring in a good way. So for that reason, that would be a vote for, or a likelihood for Harris. Let's switch. Let's go to questions here for a second here. I'm going to grab a little drink. Let's see if there are any more questions. No questions. Okay, so let's get back to finishing the presentation. We have about 10 minutes left. Areas of the market that might do well based on who wins. So again, overall, the stock market is probably going to do the same in either case. I don't anticipate a lot of drama. However, there will be some areas of the market that will do better with Harris winning and with Trump winning. So Harris has been talking a lot about promoting housing, spending money on housing, giving housing credits, things like that. We anticipate this would be good for housing industries, home builders, and construction, residential construction, and the like. I suspect the biggest winner will be renewable energy. This might be EVs, solar power, sustainable energy, that space. Climate change related companies should do well if Harris wins. And technology, that's going to be a lot of the innovation. Again, government, putting cybersecurity, these types of things should do well with a Harris victory. Donald Trump is going to be pro big business. It's going to be big corporate tax. Is going to push for another corporate tax. So you're going to be pro big business. You're going to be pro big pharma. It's going to be, Trump is definitely, hey, government, don't interfere. We don't want regulation. We don't want like EPA, fossil fuel energy. Donald Trump wins, you're going to see your traditional energy stocks do well, lower regulation, and just kind of a freer pro-business environment there. And Trump historically has been a proponent of military defense. The Ukraine topic's a little different. I don't know if we talk about military defense, building things. I think the Ukraine topic, if Trump wins, he'll put a lot of pressure to stop funding Ukraine. He's made that pretty clear. He's not a big fan of supporting Ukraine militarily or financially. What will likely happen there is there will be pressure, particularly if there is a Republican House led with Trump in the White House, to stop or certainly decrease the financial support for Ukraine. If you decrease the financial support, you're still going to probably promote the military in other areas. So that will be kind of an interesting thing to see how much money is going to be going toward the military spending if Donald Trump wins. The last thing I want to point out is the market performance in the presidential election year, that's this year, compared to the other 3 years. If you look historically, the presidential election years average return is 8.7, non-presidential is 7.7. There's not much of a difference. So some people say, oh, it's an election year, stock market's crazy, or I don't want to do anything dramatic, or I should perhaps do something dramatic. You're really not a big difference. This ties back to the very first screen where we talked about the 4-year cycle. You'd probably want to stay the course in your 4th and 1st year of the presidential cycle. Those tend to have done just fine. So there's that. I think that's it. That's all the presentation. So let me go back and see if we have any last minute questions. It's 10:24. Where do you see the interest rates going? Does the election affect that? So it's a really good question. As much as the candidates would like to talk about how they influence interest rates, they really don't have much of an impact on interest rates. Interest rates and interest rate policy is going to be a function of inflation. Again, something over which the candidates have very little control. So then you say, well, what's happening with inflation? Inflation has been coming down, not because anything Biden has done or hasn't done, or Trump or Harris. It is simply a phenomenon of 2020, COVID, all these things, a long list of reasons why there was a spike in inflation. Things are normalizing. And because they're coming back to a more kind of a predictable pattern, we see interest rates starting to come down, so inflation is coming down, therefore interest rates are coming down. The Fed, more than anyone, impacts interest rate policy. And the Fed is looking at the data, and the data says, hey, inflation is coming down. The Fed is also a little nervous. They don't want to bring down interest rates too much because they don't want a resurgence of inflation. So the reason they keep interest rates high is to slow down the economy. And so we're at right now a very neutral point in the economic cycle. The economy is doing very well. As recently as last Friday, unemployment continues, or employment numbers are strong. Unemployment continues to be not a big problem. As early as this morning, inflation is is still kind of slowing down, but not as much. The economy is still very strong, but not too strong. It is an optimum time for the economy, quite frankly. If this continues, then there wouldn't be any reason for interest rates to come down too much. If interest rates start coming down a lot, that's because the economy is weakening. So you kind of got to be careful. Do we want interest rates to come down? Well, if you can keep your job, then you want the interest rates to come down. But if you're going to lose your job because the economy weakens, we go into a recession, interest rates come down. Great, interest rates are down. But why are they down? Because we're in economic distress. So I think that right now we're in a good spot. I don't see interest rates. Interest rates will likely continue to go down as inflation comes down, but hopefully not too much, because if they come down too much, that's because we're headed for a recession. So we want things to mellow out. They have been mellowing out. Is tax policy likely to change after the election? That is probably unlikely. Trump, if elected, is going to push for a big corporate tax cut. I don't know that that's going to be able to pass, but it might. Harris, for her part, is going to push for higher taxes for the wealthy, and by wealthy that might be maybe $500,000 if you make more than $500,000 to $1 million. So not the mass market by any means. That is likely. Certainly, if Harris wins with a House that is a Democratic House, you're going to have almost likely be able to legislate higher taxes for the top 1% of 1%, but probably not affecting the mass market at all in either case. And what about the bond market? In the last minute, the bond market is tied to interest rates, as we talked about a minute ago. So the bond market has improved somewhat. Interest rates have gone up. That hurt the bond market. Then they kind of held steady for a long time. The bond market was struggling, but hanging in there. Then the interest rate started to come down last month. The bond market started to move in a very positive direction. Great time to be a bond holder. But then in the last couple of weeks, the economy is showing, hey, the economy is still strong. Interest rates may not be coming down as fast as bond holders would want. Therefore, maybe the bond market isn't as strong as we thought it might be. Nonetheless, the bond market is producing a good rate of return. It's unlikely the interest rates are going to go up. If anything, interest rates remain the same or go down, and that is good for bonds. So the bond market for conservative investors is a very good place to be right now. And certainly if the economy weakens further and we get a recession or something, you definitely want to be in the bond market in that case. I believe that is the last question, and it is 10:29. Thank you all for joining us. We'll see you in 1 month. I'm Ben Driggs, Navigate Financial. Please follow us at Navigate Financial on our Instagram, YouTube, our website. Also, we will post this webinar onto our website, and I believe this will be sent out to everyone who was on the call today. Thank you again. Have a wonderful day, and good luck. Be sure to vote. Okay, bye now.